Hi, my name is Andy and you're watching Andy's Fire Club. So today we're talking about the concept of a credit score, what it is and why you should care about it. Now before I begin, I want to tell you guys a little story. So I was talking to my friend way back in the day. I think this was when I was in high school. So we were both 18 and I asked him, do you know what your credit score is? And he's like, what's a credit score? Now this came as a shock to me. This man had existed on this earth for 18 whole years without understanding what the concept of a credit score itself is, never mind what his actual credit score is. So he just didn't really care about what his credit score was, and he didn't care about anything related to that. And I don't blame him, because talking about credit score is just about the most unsexy thing that you can think about. So you wouldn't want to bring up the idea of a credit score on a first date, for example, or on a romantic dinner. People just don't want to talk about it. But I think people should talk about it. And the reason for that is that it makes a big difference for you financially down the road if you have a good credit score versus a bad credit score. So first of all, before I start talking about credit scores, I'm going to explain a concept called creditworthiness. So creditworthiness is how trustworthy you are in the eyes of a bank or a financial institution, and that determines how willing they are to loan you money. So if you want to think about it from the lender's perspective, I'm sure you have a group of friends, and out of that group of friends, one person might be really good with money and one person might be really bad with money. So if that person who is bad with money asks you for a loan, you might not want to give it to them because you know that they're probably not going to pay you back. So you'd be kind of unwilling to loan that person money because you know that you're not going to get it back. So there's always that one person in your group that you wouldn't loan money to unless they're literally dying. And that's the idea of creditworthiness. So if the bank gives a person a credit card, they know that that person won't max it out or spend recklessly, versus if they gave the credit card with a high limit to another person, then that person might just max it out and spend it all. So maybe you don't want to give them as high of a limit, or maybe you want to give them a higher interest rate because that person is deemed more risky. Now that brings us to the second point I want to talk about, which is interest rates. So interest rates are kind of the amount of money that the bank charges you to borrow money. So think about it again from the lender's perspective. If you lend somebody money and then they tell you, oh, I can pay you back that money now, or I can pay you back that money later, and that money is the same amount, then which one would you choose? So you would rather that that person pay you back now instead of later because it's the same amount. Why would I not take my money now if I could? But if that person told you, I'm gonna pay you back later $5 extra what I lent you. So say if you lent them $100 and then they tell you, if I can pay you a month from now, I'll pay you $105, versus if you want the money now, I'll just give you your $100 back. So if that's the scenario, you're sitting there and you're thinking, maybe I don't need the money immediately right now. I would rather have that extra $5, even if it means that I'm gonna wait a month. So that extra $5 is what we call interest. And the interest rate is just how much interest is charged based on how much money was lent. So if we go back to the concept of creditworthiness, people who are less creditworthy, meaning that people who are less trustworthy in the eyes of the bank, they would actually have a higher interest rate because the bank would want more money to compensate for the extra risk that they would have to take on for that person defaulting on their loan, because the risk of them not being able to pay their loan is much higher if they're less creditworthy. So that means that they would have to charge a higher interest. So that's why the more money you spend on your credit card and the more you don't pay it back, let's say you max out your credit card, your interest rate might actually start going up because the bank sees you as being more and more risky. So this brings us to the concept of how it's actually cheaper to be rich than to be poor. Or I should say, maybe more accurately, it's actually cheaper to have a good credit score versus a bad credit score, because if you have a good credit score, then that means that you're more credit worthy. So you're more trustworthy in the eyes of the bank, which means that they're comfortable with giving you a lower interest rate. Now, if you think about it, this might be kind of backwards, because you think, oh, maybe rich people who can afford to pay back their loans, they get to pay a lower interest rate than I do because I don't have enough money. So let's say if I don't have enough money to pay back my loan, and I don't pay my credit card in full and they raise the interest rate on me, how is that fair? Well, from the eyes of the lender, you not being able to pay back that loan means that you're less trustworthy, so they need to charge you more to compensate for the risk. Now, you might not think that an extra 1 to 2% or something like that on a loan is a big deal, but if you think about it in terms of a mortgage, let's say you manage to get a 30-year mortgage for 3% versus a 30-year mortgage for 4% or 5%, just because if you think about how much money people owe on a mortgage, and it's such a large amount over such a long period of time, then a 1% difference makes a huge difference. It's just tens of thousands of dollars. Just because your interest rate is maybe 1% higher, then you have to pay tens of thousands of dollars extra. So having a good credit score would ensure that you get the lowest interest rate possible. And this could obviously save you tens of thousands of dollars down the line for reasons that we've just talked about. So maybe by now I've convinced you why you should care about your credit score. And now the big question is, how do you build up a good credit score? So the way that they measure credit score is kind of different between Canada and the United States. So I know here in Canada, I think the credit score goes up to 900, and versus in the US, it only goes up to 850. But minor differences aside, if you have a credit score of say over 700, then that's usually a really good score. So how do you get to a credit score of over 700? That's the big question. Chances are you're gonna need a loan at some point in your life for whatever reason, and having the lowest interest rate possible will save you a ton of money. So yeah, let's talk about how to build a good credit score. So the first thing that you wanna do is make sure you pay off your credit cards in full and on time every month. Now, I can't stress this enough. This is the most important thing that you will ever encounter in terms of credit score, is that the biggest hits that you will take to your credit score is that if you don't pay back your credit card on time. And this matters because obviously, again, think of it from the eyes of the bank. So if you don't pay them back when you're supposed to, then the bank's gonna automatically see you as being less trustworthy. So I'm not gonna explain this one any further. I think it's pretty self-explanatory. Now let's move on to the next one. So the next one is credit history. So this is one that not a lot of people think of, is that they want to see a record of on-time and in full payments. Let's say that you never had a credit card in your life. So you may be a new immigrant from another country who that doesn't use credit cards, or you may be really young. Maybe you just turned 18 and you just got your first credit card, and you don't have a lot of history in terms of your credit. So history just means that banks want to see a record of you being able to pay back your credit card debts on time and in full. So if you just had a credit card, or if you don't have any credit cards at all, then you don't have a credit history. And then if you don't have a record of you being able to pay back your credit, then that's gonna be a knock against you in terms of the credit score. So the solution to this is just pretty simple. Is you get a simple starter credit card. There's a lot of credit cards that are aimed specifically at, let's say, new immigrants or really young people who might not have had a credit card in the past, and the requirements are pretty low. So you get one of these beginner cards. Don't overspend it, and the limit's probably going to be really low anyways, but don't overspend, don't go crazy with it, be responsible with it. Buy a cup of coffee every month or every week or something with the credit card, and just put it on the credit card and make sure you don't forget about that cup of coffee. Pay it back on time and in full. And that way you can start building up a credit history. Now, one of my friends recently told me that she only has one credit card, and she hasn't had that one credit card for a long time. And she checked her credit score one day, and her credit score was actually pretty bad. She couldn't understand why, because she always made in full and on-time payments every month. And she's been wondering why, that even though she's been paying her credit card on time and in full, that her credit score is very low. Well, that's because she might not have had a good credit history. So she just opened up the card, and the bank doesn't see a long enough record for them to really trust her. And another problem, going back to my friend's example, is that that's the only credit card that she has, and she doesn't have a mortgage, she doesn't have her own house yet, or she doesn't have her own car yet, so she doesn't have a car loan or a mortgage. So all she has is that one credit card, and that means that she doesn't really have a good credit mix. So what a credit mix is a variety of different types of loans. So banks like to see that you don't just have one type of credit. They want to see maybe you have mortgage, or maybe you have car loan, or maybe you have credit cards, or maybe you have a personal line of credit. So if you have a good mix of different types of credit and you're able to make your payments in full and on time every month, then that would improve your credit score a lot more than if you just had one thing. And lastly, something called the credit utilization ratio. Now, I know this kind of sounds like a really long, complicated thing. It's not, I promise. So what a credit utilization ratio is how much credit you have versus how much credit you're using. So for example, if you have a credit card that has a limit of $1,000 and you spent $800 on it already, so your credit utilization is 80%, or 0.8 if you want to express that as a ratio. So you're using 80% of the credit that's available to you. Well, that might be a bad sign in the eyes of the bank. So let's say there's a friend of yours who you don't really trust with credit, and he asks you for $100 for a loan, and you don't really want to give it to him, but he asked nicely, so you're like, whatever. And then you lend him that $100. And a week later, you check back. Would you rather hear that he has spent $80 of that $100 you lent him already, or would you rather hear that he only spent $10 of that $100 that you lent him? Of course, you would probably trust him more if he only spent $10 out of that $100 that you lent him, because that means that he's not just spending every single dime of credit that he's getting. So same thing with you having a credit card, and in the eyes of the bank, you're that untrustworthy friend. So if the bank loans you some money, they don't want to see that you're spending 80, 90 to 100% of it already, because that means that you're more likely to max out your credit card and you're more likely to default on your loan. Not being able to pay back your debts is called defaulting, by the way. So generally, as a rule of thumb, you want to keep your credit utilization below 30%. That means that, let's say you have a credit card with a $1,000 credit limit on it, at all times you should try to keep your balance below 300. Now keep in mind that, let's say if you have $10,000 of credit limit across 5 different credit cards, now then that means that your credit limit, you can add the limits together, and then let's say you max out one card and that one card has a $1,000 credit limit and you max it out, well then you're still good because you only spent $1,000 on that one credit card, when in total across, let's say, 5 credit cards that you have a combined limit of $10,000. So your credit utilization ratio is still only 10%. So you can add your credit limit that's available to you across all the credit cards that you have, and then you can add the balance of all your credit cards that you've already spent, and then do it in a sort of aggregate way, such that you add up everything and then you find out how much credit that's available to you versus how much credit that you're using. So that's the way you kind of want to think about how to calculate credit utilization ratios. So with that being said, these are the things that determine how creditworthy you are, and these are the things that determine how good your credit score is. So I hope I've convinced you in today's video on why you should keep an eye on your credit score. There are a ton of free services that will let you check your credit score. So for example, I use Credit Karma, totally not sponsored. They didn't pay me to say this. I just like their product and I use it for my credit score purposes, but you don't have to use Credit Karma. You can use, there's a whole bunch of different services that you can use. Make sure you hit the subscribe button and make sure you hit the like button, because it really helps out with the YouTube algorithm. As always, be sure to follow me on Twitter and Instagram. I'll leave the links down below in the description. Anyways, thanks for watching. I'll see you guys in the next video.